Now that you understand candlestick anatomy, let's talk about bullish and bearish candles. These candles show who controls the market: buyers or sellers. Let's start with bullish candles. A bullish candle forms when price closes higher than it opens. This means buyers were stronger during that period. Bullish candles are usually green or white. A strong bullish candle has a large body and small or no upper wicks. This shows buyers stayed in control until the close. Now let's look at bearish candles. A bearish candle forms when price closes lower than it opens. This means sellers controlled the market. Bearish candles are usually red or black. A strong bearish candle has a large body and small or no lower wicks. This shows strong selling pressure. But not all bullish or bearish candles are strong. Small bodies show weak control. Long wicks show rejection and hesitation. This is where beginners often get confused. They assume every green candle means buy, and every red candle means sell. But candle color alone is not enough. You must look at context. Where did the candle form? Is it at support, resistance, or in the middle? A bullish candle at resistance can be a trap. A bearish candle at support can be misleading. Candles show short-term control. Trends and structure show the bigger picture. Always combine both. This will keep you out of many bad trades. Quick recap. Bullish candles show buying pressure. Bearish candles show selling pressure. Strength matters more than color. Context matters more than the candle itself. In the next video, we'll cover time frames explained.